In the volatile financial landscape of April 2026, structured settlement annuities have re-emerged as the bedrock of long-term security for personal injury victims and those seeking reliable, tax-advantaged income streams. A structured settlement is essentially a financial arrangement where a claimant agrees to resolve a personal injury lawsuit by receiving a portion or all of a settlement in the form of periodic payments on a fixed schedule, rather than as a single lump sum. As of early 2026, the hallmark of the industry is the high-yield renaissance, with top-tier carriers offering lock-in rates as high as 7.05% for long-term payouts. This makes structured annuities a superior alternative to traditional bonds or volatile equity markets, especially for those who cannot afford to lose their principal. High CPM keywords such as Best-Rated Structured Settlement Carriers 2026, Tax-Free Annuity Payouts for Personal Injury, and MetLife vs. Berkshire Hathaway Structured Settlement Comparison attract premium advertisements from multi-billion-dollar life insurance companies, specialized settlement brokers, and wealth management firms, making this a top-tier niche for B2B and legal finance content creators in the United States. A major structural evolution in 2026 is the dominance of superior financial strength ratings as the primary selection criteria. In an era of economic shifts, claimants are prioritizing companies with AM Best ratings of A+, superior, or A++, excellence. The leaders in the 2026 market include industry titans such as Berkshire Hathaway, National Indemnity Company, known for its unparalleled capital reserves, MetLife, which has specialized in complex mass tort settlements and taxable structured settlements for employment litigation, and Prudential, recognized for its innovative life contingent payout structures. Additionally, New York Life and Allianz have introduced AI-driven digital portals that allow annuitants to track their future payment schedules and inflation-adjusted bumps in real time. However, to remain compliant with YouTube's financial and legal integrity policies, it is mandatory to clarify that a structured settlement is generally irrevocable. Once the annuity is established through a qualified assignment, the payment stream cannot be easily changed or accelerated without significant tax penalties or the involvement of secondary market settlement purchases. Promoting these annuities as liquid cash, without explaining the long-term commitment, is a direct violation of transparency standards. The 2026 model for selecting the best company also highlights the rise of non-qualified structured settlements for non-physical injury cases, such as wrongful termination, sexual harassment, or environmental disputes. While personal physical injury payouts remain 103(2) tax-free under the Internal Revenue Code, these non-qualified structures offer a massive tax deferral advantage for claimants in high-income brackets. For creators, this niche provides immense depth, from explaining the role of a structured settlement consultant, to how to evaluate an annuity quote using the internal rate of return, IRR, by providing evidence-based insights into qualified assignments and the latest social inflation impacts on settlement values. We empower families to protect their financial legacies. Furthermore, the 2026 market has seen a surge in inflation-linked riders, where payment amounts increase by a fixed percentage, typically 3% annually, to combat the rising cost of living. Ultimately, the 2026 structured settlement landscape in the United States represents the perfect marriage of legal protection and high-yield financial engineering, ensuring that even after a life-altering tragedy, every claimant has a secure, predictable, and dignified